This video, I just want you to understand some of the numbers so you can have an educated conversation with another investor, a broker, a buyer, or a seller, whoever it is that you're going to deal with, your investors, right? So your NOI is your net operating income. Your ROI is your return on investment. Your cap rate, determined by the market, sales prices, is your net operating income divided by the purchase price. And then your cash on cash return is your annual cash flow divided by the total cash invested, your down payment, times 100. So NOI, ROI, cap rate, cash on cash return. Hey, what's up, all my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast, Yellow Golden Nugget. So this one was put together. We got a question in from one of our podcast viewers. Mike asked this question. It's like, okay, I'm watching all these podcasts. It sounds good. These people are making a tremendous amount of money, but they keep talking about their numbers. So how do you know their numbers, and what are the numbers? I want to unpack this video a little bit to walk you through NOI, ROI, cap rate, and your cash on cash return. So before you shut this off and figure I'm not doing algebra today, let me just break this down in bite-sized chunks so you can figure this all out. Okay, so let's start with the real basic stuff. You're going to purchase a property. So for this example, we're going to use just a small 4-unit property. Now, the numbers will multiply up. If you do it a 4-unit, a 40-unit, or a 400-unit, you're just adding zeros to the end of it. The bigger the zeros, the more careful you have to be because your margin of error is huge. So let's start small, something not too scary. A basic 4-unit property. We'll wait for this plane to go by. Yeah. Enjoy the island. Okay, so for this unit, for this example, let's start with a 4-unit property, and let's say it's $150K a door, or $600,000. $600,000. At 20% down, that's $120K. You're going to have a $120,000 down payment, and you're going to have a mortgage for $480,000. So that's just the purchase price, okay? $600,000, 20% down is $120K. The mortgage is $480,000. Purchase price. The next metric we need is what's the income? So in this example, I'm figuring $2,000 of rent for 4 units is $8,000. Let's throw in $150 for storage units down in the basement. That'd be another $600. And a coin-operated laundry pulling in around $400. So let's just figure that all out. Let's say it's $900 a month gross income. That's your rents, everything included, right? And this is just an example. You may have other things or less things or more things, but you need to know your gross number. For us example, it's $9,000 a month, the gross income. Okay? Now, $9,000 a month times 12 is a gross income of $108,000 a year. That's the gross money that this thing's going to pull in. So we know our purchase price, we know our gross income. Next, we have to figure out our expenses. So I threw some basic numbers here, and again, you might be buying up south, down north, east, west, wherever your market is. You can talk to realtors, brokers, mortgage lenders. They'll have an idea. Your municipalities, they'll have an idea what your mill rate and your taxes are, your insurance. These numbers are not to say, okay, this is what the number should be. I'm just giving you some 30,000 foot of what you can anticipate for expenses. So you're going to have your water, your utilities, your insurance, taxes, repairs, basic maintenance, and management fee. I want you to figure out your management fee into your deals because I want you to think like an investor. Okay? So if I totaled all of this up, typically expenses run reverse. You figure out the annual that it will cost you, then you divide by 12. So our annual expenses for this model is going to be $12,480. If I divide that by 12, it's going to be $1,040 a month. Okay, so now we know our gross income at $6,000. We know our gross expenses at $1,040. So that's going to give us a net income before debt, which is actually our NOI, of $7,960. So if I take that $7,960, multiply it out by 12, that's going to give me my annual NOI, my net operating income. Net operating income, okay? For this deal, the net operating income is $95,520. Now that's before debt service. Debt service is your mortgage. Remember that $480,000 that we borrowed from the lender? That's our mortgage. So our NOI, net operating income, is the number annually before the debt service. So now we've got all of our numbers into play here. We know our income, we know our expenses. We need to figure out our mortgage. So that $480,000, I went into a mortgage calculator. For 20 years at 7% is a monthly mortgage of $3,847 a month. So that's going to leave us a net monthly cash flow, this is after the debt service, of $4,113 a month, which is an annual cash flow net of $49,356. So I'll have all these slides up here so you can see it. I'll have the examples down on the bottom so you can run your own numbers and do the math. So let's dig into our numbers. The numbers, this is for Mike. Your net operating income, we already figured that one out. It is before the debt, your net from your operating expenses subtracted from your gross rents. So your gross rents, $9,000 or $108,000. Your annual expenses of $12,480 gives you an NOI of $95,520. That's your net operating income. The next one you need to figure out is your ROI. That's your return on investment, your annual return on investment. So your 108, again, we're going for your gross rents minus your gross expenses, that $12,480, and that number, that $9,500, divided by your mortgage amount, $480,000, gives you your return on investment. In this example, it's 10%. Most investors like to be within 8 to 12% on their windows. And, you know, people buy for different reasons. Some people may buy in one area of the country for cash flow. They may buy in another area of the country for appreciation. They may buy smaller buildings because they're easier to purchase, and some people believe that because there's less money needed. Or they may focus on the larger deals because there's less work after the purchase. And again, this is all relative. What you might think is less work, I might not think is less work, and vice versa. So people buy for different reasons, but they usually have a buy box for criteria. Their NOI, ROI, cap rates, and cash-on-cash returns. So we've looked at our net operating income. That's before the debt service. Our ROI is the return on our investment. So we have to take the NOI, divide that by the mortgage, and that's going to give us our ROI. In this particular example is 10%. Now the cap rate, IRV, income, value and revenue, or whatever it is. Anyways, I'll give you this one real quick. Cap rate is your net operating income. Again, it's that $95,520 divided by the purchase price of $600,000, which is going to move the decimal points over. So you have to multiply that times 100%, and that'll put the decimal points in the right place. So your cap rate is the $95,520 divided by the $600,000 purchase price. Got a little wind here. I'll let that get by the camera. So your $95,520 divided by your $600,000 purchase price multiplied by the 100 to move the decimal points over. In this particular deal gives you a cap rate of 16. Now, some of you may be drooling at this video saying, oh my God, a 16 cap rate, where is he buying? This is not a real deal. I'm just presenting income, expenses, purchase price, so we can have some numbers to work with, so you can run your own calculations to know your numbers. So the cap rate in this deal, you have your net operating income divided by the purchase price times 100 gives you your cap rate. Okay, here it's 16%. Now your cash on cash return, this is a number that a lot of investors look at. They want to know how quickly they're going to get their money back from this deal. Okay, cash on cash return is your annual cash flow, and for this it's after the debt service. So it's $49,356,000 divided by the total cash invested. For us, it was our down payment of $120. So if we're going to take our $49,356, divided it by $120,000, and then we'll multiply it by 100 to get our decimal points in place, that is a whopping 41% cash on cash return, which means the investor is probably going to make their money back in about 2.5 to 3 years, extenuating circumstances. 2.5 to 3 years. That is a pretty good deal. When we were buying our small properties, those are the numbers we were looking for. We were averaging around 35%, which would take us just around 3 years to get our money back. Okay? Can you always hit those numbers? No. Do some investors buy for those numbers? Yes and no. Again, an investor will buy for whatever criteria that works best for them. This video, I just want you to understand some of the numbers so you can have an educated conversation with another investor, a broker, a buyer, or a seller, whoever it is that you're going to deal with. Your investors, right? So your NOI is your net operating income. Your ROI is your return on investment. Your cap rate, determined by the market, sales prices, is your net operating income divided by the purchase price. And then your cash on cash return is your annual cash flow divided by the total cash invested, your down payment, times 100. So NOI, ROI, cap rate, cash on cash return. Hope that makes some sense. Mike, that one went out for you. This is Brian Lucier. I'm here overlooking the Caribbean, getting out to have my night walk. Really enjoy that. Real estate has got me here. So if you have dreams and ambitions, learn your numbers, learn how to calculate a deal, find out more about your market. We've got other yellow podcasts that'll help you with all of that. But for right now, this is Brian Lucier from the Why Not Real Estate Podcast, Golden Nuggets. We're signing off. We'll see you on the next one.